Berkshire Hathaway is no longer the same investment story. For decades, investors bought Berkshire because they trusted Warren Buffett to turn massive amounts of capital into extraordinary returns. But now, Buffett is gone as CEO. The company is sitting on nearly $380 billion in cash, and the real question is brutally simple. Can Berkshire still outperform when the greatest capital allocator in history is no longer running the machine? The business itself is still extremely strong. Berkshire generated around $371 billion in operating revenue during 2025, insurance operations remain profitable, and book value per share keeps rising at a healthy pace. First quarter 2026 operating earnings jumped nearly 18% year over year, while cash levels hit another record near $380 billion after continued stock sales. But the deeper story is that Berkshire is becoming more defensive. The company sold huge positions in Chevron, Visa, MasterCard, United Health, Domino's, and other holdings, while aggressively concentrating into fewer bets like Alphabet. That tells you management is becoming more cautious about opportunities and more selective about future capital deployment. The stock is not expensive, but it is also not the screaming bargain Berkshire investors use to get during crises. Morningstar estimates fair value around $765,000 per Class A share versus a market price near $727,000, which implies only modest undervaluation. The problem is that the valuation still assumes Berkshire can continue compounding capital efficiently despite its enormous size and leadership transition. At over $1 trillion in market cap, Berkshire simply cannot grow like it used to. For this valuation to really work, Greg Abel must prove that Berkshire can evolve from a Buffett-driven investment vehicle into a highly disciplined operational empire with stronger efficiency and smarter capital deployment. What Berkshire is becoming now is actually very different from the classic Buffett-era story. This is slowly transforming into a giant infrastructure, insurance, industrial, and cash management platform. Railroads, utilities, energy assets, manufacturing businesses, and insurance float now matter more than legendary stock picking. Greg Abel appears far more operationally focused than Buffett ever was, and that could eventually improve efficiency across Berkshire's sprawling empire. But it also means Berkshire may gradually lose the magic premium investors associated with Buffett's investing genius. The company is moving from extraordinary compounding toward high-quality industrial stability. Berkshire still has major advantages against competitors like Progressive, Allstate, and Markel. Geico remains one of the largest direct auto insurers in America, BNSF owns an irreplaceable rail network, and Berkshire Hathaway Energy controls massive regulated utility assets. But cracks are appearing. Progressive continues executing extremely well in auto insurance. Union Pacific still operates more efficiently than BNSF, and private equity firms now compete aggressively for acquisitions Berkshire once dominated easily. Berkshire still has scale, balance sheet strength, and low-cost insurance float, but the market environment is far more competitive than it was 20 years ago. The biggest risk is not a recession or insurance losses. The biggest risk is slow decline. Berkshire's returns have already started trailing the S&P 500 over the past decade, and the company's size makes finding meaningful investments incredibly difficult. If Greg Abel becomes too conservative, Berkshire could slowly turn into a gigantic, low-growth conglomerate with average returns and excess cash piling up endlessly. There is also execution risk across multiple businesses at once, including Geico competitiveness, BNSF operational efficiency, wildfire liabilities in utilities, and weaker acquisition returns. The investment thesis breaks if Berkshire loses its ability to allocate capital better than the market. The upside case is actually very powerful if Abel executes well. Berkshire still controls one of the strongest balance sheets in the world, owns elite infrastructure assets, generates massive free cash flow, and has enormous flexibility during market stress. If markets crash or acquisition opportunities appear, Berkshire can deploy hundreds of billions faster than almost anyone else. There is also room for higher buybacks, potential dividends in the future, and operational improvements Buffett largely ignored. Success would look like Berkshire evolving from a legendary investor-led company into an ultra-efficient capital machine capable of producing steady double-digit compounding without relying on Buffett's personality. This is no longer a Buffett genius stock. Berkshire Hathaway is becoming a transition story. The company is still incredibly strong, financially elite, and probably safer than almost any trillion-dollar business on Earth. But the easy narrative is gone. Investors now need to believe Greg Abel can manage capital, improve operations, and keep Berkshire relevant in a far more competitive world. This stock is no longer about magic. It is about execution. And that makes Berkshire far more interesting and far riskier than most investors realize. I'll break down the next one soon. Subscribe if you want to stay ahead.